Good morning, everybody. Got to say straight away, thank you so much for so many people registering and re-registering for the webinar, Basic Accounting and the Engineer. And I will just make a quick apology. We had tremendous IT issues, which we don't know where they came from. It might have just been general internet overload due to the coronavirus situation, but apologies anyway. And there was so much interest that we are going to run the webinar through again to give everybody the opportunity to hear it properly and also to ask questions at the end. So without further delay, let's get going, and I hope you find it a very interesting session.
Basic Accounting and the Engineer, presented by the management group at the Institution of Mechanical Engineers. I'm Christopher Simpson, and my co-presenters are Paul Ballington and Tim Podesta. We all are members of the management group board. This is the fourth in a series of webinars presenting aspects of finance to engineers, and essentially those engineers who are going through the transition from a mainly technical role into one where they're taking on increasing management responsibility. Just a few words about the management group before we start the main elements of the webinar. The objective of the management group is to support the development of engineers to maximize their potential and be recognized leaders of the future, to increase the management skills of engineers with a focus on young engineers, as I said, making the transition into management positions, to promote and present the best practice in engineering management to members of the IMechE, both here and overseas, to support the annual essential management skills run by the young engineers of the institution, to provide support and encouragement to the UK engineering sector in general, and to encourage an increase in the number of engineers in the most senior leadership roles, both in the private and the public sector. So that's my brief introduction. I'd now like to hand over to Paul Barrington, who will be doing the first of the three parts of this seminar today.
Thank you, Christopher, for that introduction. Good morning, everybody. Welcome to our latest talk in this series. This talk is aimed at demystifying two of the fundamental financial reports that you'll see about a company, the balance sheet and the income statement, and then looking at how we can use those figures to understand the company's position. The third document, which is quite key, is the cash flow statement, but we feel that when you've seen these two talks, the cash flow statement will start to fall into place on its own. So let's start then with the balance sheet. The balance sheet, or statement of financial position. It shows a company's assets, and these are its resources. And through the liabilities and the shareholders' equity, it shows how those resources were funded. And it's very, very important to understand that the balance sheet represents a snapshot in time, usually the end of a financial reporting period, a quarter or a half year, or the end of a financial year itself. So it's important that it's a snapshot at that point of time. Other documents show what's going on between those times. There is a convention of conservatism in accounting, and it's applied to the balance sheet quite rigorously. So the balance sheet is based on historic cost only. And so all the numbers here about the value of an asset are based on what it was actually bought for and how it's been depreciated or used up since. There's no attempt to set fair market values in the balance sheet. And some assets, which you might consider they're very, very valuable, like a valuable brand name, if they were developed by the company whose balance sheet they're on, they actually can't be given a value. They can only be valued when you sell them and somebody buys them, and then they can show the value that was paid for them. So if you're Nike and it's Nike's balance sheet, the Nike brand would actually have no value on your balance sheet. And so through this conservatism, the balance sheet doesn't represent the true market value of a company. I'd like to, because we're all engineers, I would like to introduce an equation which must hold true. And this is the balance sheet equation. And I've got it in this order because then it aligns with the balance sheet itself. So a company's assets must equal its liabilities plus the shareholders' equity. And that equation must always be true, otherwise there is something wrong with the accounts that have been presented. So without talking any further, but please remember that very simple equation that assets must equal liabilities and shareholders' equity. Let's move on to looking at a balance sheet. To make this realistic, I've taken a balance sheet from a very large company and then anonymized it to make it the management group's balance sheet. So we're doing very well, as you can see. It's important to know that basically a balance sheet is deliberately given a simple and very standardized format. So you can look at a balance sheet for any company, large or small. So it could be a one-person company, it could be a small enterprise or medium-sized enterprise, or it could be a very large public company. In this case, this is a large PLC, because when we expand each of these categories in the coming slides, I wanted there to be some richness for us to look at. But looking from the top of the balance sheet down, you'll see it describe assets first, then the liabilities, and at the bottom, the shareholders' equity. And you'll see from the numbers there that if you take the assets, which are a positive thing, have positive value, you've got 207 billion in this case. Did say it was a large company. If you look at its liabilities, which have a negative value, then you have 145 billion of liabilities. Add the two together, you get 62 billion pounds of shareholders' equity, and that equals the net assets. And so it's important to know that basically the shareholders in a company basically own all assets that a company has. So let's talk about assets. You'll see here that assets are split into non-current assets, and the non-current assets are split into two groupings, fixed assets and others. And the basically non-current assets, the way you decide what's current and what's non-current is whether those assets could be turned into cash or will be consumed to produce cash by the business within the financial period that we're looking at, or sometimes it would be what its amounts will be consumed within the financial year if you're looking at a quarterly report. So fixed assets then. We're looking at things like property, plant and equipment. You'll see that shortened to PP&E. Goodwill, this is where you bought a company. Intangible assets, this introduces an important thing. You'll see a column with notes on it. Notes are where the real information lies. So if you see a large number of intangible assets, £10 billion, what's that? Go and look at the notes and it will explain it. And so then, and you can look at here and you can have a look at investments in associate businesses and other investments. You then come into, so that's the fixed assets. They're things that are, it would take you a long time to turn them into cash. Okay. Then you look at the others, then you have things like loans the company's made, trade receivables, derivative financial instruments. That could be a hedge book, it could be derivative-based contracts based off, if it's a mining company, gold, iron, whatever. And so that gives you another classification of assets, which is this other, which is a catch-all. And then you look at current assets. So the current assets are the things that that a company can immediately employ in using its in driving its business along. And you're looking at, in this case, cash and cash equivalents, and the other classification I've got here is assets classified as held for sale. So obviously there's a lot of detail missing there. So let's have a look at the assets exploded. And you'll see here that loans the company's made that can be called in within a year are there. Inventories, so the work in progress and the raw materials of the company. Debts that you're owed that should be due. Again, derivative financial instruments, a very complicated area. A lot of us tend to spend quite a bit of our time trying not to contract an embedded derivative, because it can usually be quite expensive if you make that mistake. Prepayments. Interesting here. If you've got a large amount of profit in a year, you could actually get a discount by paying for some of next year's material early. And the discount you'll get would be bigger than the amount of money you'd get for having that cash in the bank. So you prepay for things. Taxes, you can see as assets and liabilities, so they balance each other away. And then you look at, obviously then, money in the bank. And this company's got quite a lot of money in the bank, about £13 billion. But again, I'd like to return back to, very important to use the notes to understand the balance sheet. Looking now at the other side of the balance is the liabilities, and then into the shareholders' equity. The liabilities again show the same split as assets, current and non-current. So again, current liabilities, things that happen that would be due to be repaid, amounts that will go out of the company within the current accounting period or accounting year. And you see there, this is paying your suppliers. Derivatives, always there on big company balance sheets. Accruals, this is where you've got something that's going to go on over the end of the accounting period. And so to avoid paying too much tax or showing a false position, you accrue the costs that you're going to have to pay out when the bill comes in. So you've made something in 2019, you've consumed the materials, etc. in 19, you're going to pay the bill for it in February, so it falls in the next accounting year. So you accrue it into 19, so what they call the temporal matching stays right. And so you don't see a big profit in 19 and then a big loss in 20. That would obviously be a rather silly thing to do. And so that's covered through the current liabilities. Now, non-current liabilities, these could be things like leases. So you've got a 12-year lease on something, a 60-year lease on something. You're making provisions for something that's happened. There's been you're aware that there's a major cost overrun you're expecting on one of your programs because test results are showing that the product isn't as good as what you thought it was going to be, and you might need another couple of $100 million or 100,000 or whatever the size of the business is, and so you need to make a provision for that eventuality because it's becoming quite likely it's going to happen. And then again, you're seeing in here, I think you saw it in assets as well, the pension plan can be quite important to companies as well. So that's basically give you an idea. And of course, not to mention, in these times, financial debt, people are borrowing more and more money. And so you'll see that going on to the liabilities. And you'll see a situation here where you've got the total liabilities, you take that off the total assets, and that gives you the balance. And then the balance then will feed across into the shareholders' equity. Now, shareholders' equity also funds assets, as I said before. This is the in the balance sheet equation. This is the other part of it, and shareholders' equity represents everything the shareholders own. And again, we'll split this out. But and if you look below, we've got shareholders' equity is 62 billion pounds in this case. But what's in there? Common shares, preference shares, IMechE. Interesting thing here, if you've seen a company that might have a 50p common share, but actually it sells for £10. So if a company issues new shares, the value, the £9.50 over the 50p, is additional paid in capital. Treasury shares, this is where a company's bought back some of its own shares or it's retained some of its shares. So those treasury shares, again, belong to the shareholders. And importantly, retained earnings. And I'll come back to retained earnings in a minute or two. But obviously, this is where your profits accrue, and then the retained earnings, and then you'll pay out things like dividends to shareholders. But the important thing here is the retained earnings. And we saw above an area of shareholders' equity called non-controlling interests. And this is where the company doesn't own the majority of an associated business, but it has a significant portion of it. So the management group own 20% of a consulting engineering company. This is where we represent the value of the 20% of that company that we own. And so, coming back to what I said, the balance sheet equation, assets equals liabilities plus shareholders' equity, must hold true. This is a very big, very complicated company. It's a real company's balance sheet, but I've played with the numbers, so I'm not conveying their information outside of their control. But you can see here is absolutely the balance sheet equation holds true, and it leads you through the balance sheet. And the other point to make is that the notes, the balance sheet is one sheet, and it's the same for just about every company of every size. But it might lead you through into 2 or 3 pages of notes, or it might lead you through into hundreds of pages of notes in an annual report. But when it comes down to it, that equation must hold true, and the notes will tell you what's going on. I'd now like to hand over to Tim Podesta, and the link from the balance sheet to the income statement is the retained earnings. These two things should show up and make sense. So I'd like to hand over to Tim now, and thank you very much for your attention.
Thank you, Paul, for your kind introduction. Assembled guests, let me start with a question. Who has experience of working with the income statement? Have you been involved in budgeting, forecasting, or reporting? If yes, then you will have contributed to the accountant's domain through cash flow and the income statement. If no, then I'm sure you will do so in the future. Looking at the first slide, in summary, the income statement, otherwise known as profit and loss, P&L, has certain characteristics. It covers a financial year, which can be calendar year, January to December, or April to April, or occasionally something else. It is a record of the past year's trading performance. It includes cash and non-cash costs, and it's used for calculating the tax liability. And I have an example to show you. Moving to the second slide, here's a simple summary of the components of a group income statement. Now, like the balance sheet, it has fictitious numbers, which are similar order of magnitude to the balance sheet we looked at. And this is to illustrate the statement. The line items which run down the slide, they give the annual profit at various levels, both before and after interest and tax. Starting at the top by line item, revenue. This is related to the product or service of the organization and is normally a function of volume and price. Next is the cost of sales, and these are the variable costs related to the product or service, such as labor and materials. There can be other variable costs, such as repair and maintenance, consumables, power and transport. All of the variable costs are then added together to give the total cost of sales. Revenue minus cost of sales then gives the gross profit. Next are the operating expenses or fixed costs, sometimes described as overheads. This can include buildings and head office costs. Next is income, or indeed expenditure on investments the company has made, for example, joint ventures. Then there are the non-cash costs. The main one is depreciation on assets, which is the cost of an asset which has been invested in, expensed over time, normally the estimated asset life. Now that is a non-cash cost. Then taking these and other costs into account gets us to the total operating profit. Next, we take into account payment of interest on company loans, which are shown on the balance sheet. And finally, there is a very important tax charge based on the profit after interest and non-cash costs. Now, there are three things from my experience that are important about tax. First is the tax rate. Then there may be capital allowances that can be applied based on investment and other factors. And thirdly, there is the potential carry forward of tax losses from previous years, which may be applied. Now, focusing on the lines at the top of the income statement, from revenue down to operating profit, these are all related to the cash flow. Now, that's very important for three reasons. Firstly, the cash flow is an important issue for company health, and company failure is often due to cash flow problems. Secondly, it's the basis for investment analysis and calculating things like the net present value, or NPV. Now, that was a subject of previous webinars. But thirdly, it is the space that as an engineer or manager of engineering, you are most likely to be concerned with. And it makes a big difference if you can have an understanding of company accounts and can converse with accountants. Now, I have stories from my time in roles during my career where I had financial responsibility to share. Moving to the next slide, my first experience was as a chief of staff and commercial manager. I was accountable for an annual operating expenditure budget of $25 million, which included a team of 50 staff and contractors. This was in a corporate department. It was providing IT services and projects across the group. I was responsible for budgeting and the quarterly and annual forecasting done by the team. Now, the problem was that the forecasts were inaccurate. The errors in quarterly forecasts we were experiencing across the team had a number of parts, ranged from 30 to 70% out, 30 to 70% out. Normally it's an underspend. And the range of full year forecasts was up to 15% out, 15% out. That was not acceptable. Now, I led a continuous improvement Six Sigma project looking at the details of the budgeting and the forecasting process. What I found was that the behavioral issues in the team were a root cause of errors. And the impact was that there was unwise spending at the end of the year and missed opportunities for wise spending earlier in the year. Now, my story is of a leadership meeting at a plush hotel near London, and the moment the different behaviors came to the fore. One of the team leaders' approach was to micromanage the costs, and he actually achieved a result which was too good. It was well within a 3% forecasting target. that we'd set. Another director's approach was to play the budgeting game and hold a reserve of expenditure in their budget up their sleeve, which quite often came home during the year and certainly at the end of the year. Now, these were extremes of behaviour in budgeting, and I remember the moment these two directors came face to face in the leadership meeting. There was a moment of tension, but in an environment of trust created by data and benchmarking based on the Six Sigma project we were doing, there was a realization. And it was agreed that the next round of forecasts will be tempered to allow some flexibility. On one hand, there will be less need to micromanage, and on the other hand, there was a significant challenge to one of the team leaders to change their budgeting approach. This resulted in less unwise spending and more opportunities for wise spending. Moving on to my final slide, and another story. It was an experience that I had when I was a program director for a global safety and operational risk program. Now, this was funded by a $15 million cost of sales expenditure. And I was responsible for activity planning, contracting, budgeting, and reporting. In one of the major offshore oil and gas regions that I was working with, the specific activity was delivering major process safety improvements and consequently significant reliability improvements as well. The two are linked. So it was a really successful project. But as we were delivering it, there was a concern as to how this would show up in the accounts. The impact of the project was an increase in $100 million of revenue from improved reliability and lower costs of maintenance, arising for the $10 million local investment I was managing. Now, I remember very well spending time in the large regional office with the lead business accountant, a feisty lady with significant experience. And the big moment came around the end of the third quarter of the year. We were due to complete the activity in the fourth quarter, and the business, represented by the accountant, wanted to go into the next year with no accounting surprises. It was an intense conversation with the business accountant, and she asked, would the financial books at the end of the year, the income statement, be complete regarding the program I was managing? Would all costs be accounted for, invoiced, and accrued? And would the work be completed satisfactorily? Now, based on the business and financial processes I had put in place and my relationship with supplier and the accounting team, I said with confidence, yes. And when the dust settled in the first quarter of the next year, the prior year accounts held no surprises. The accruals matched, the work was completed satisfactorily, and there were no costs outstanding. In summary, our look at the income statement has taken us on a journey to understand the income statement, profit and loss, and cash flow, budgeting, forecasting, and reporting, a journey which I hope you will enjoy in your own careers. It is my pleasure to hand over to Christmas Simpson for the third part of this webinar.
Hello. I'm going to present this last session covering key financial ratios. Ratios are a useful tool by which management can analyze quickly and efficiently the performance of their own business and that of other businesses. It helps to determine the current performance and assists in decision-making and planning. The basis of ratios is that they are produced from numerical values taken from the balance sheet, the income statement, and the cash flow statement. And they can be used to assess a company's liquidity, growth, margins, profitability, rates of return, valuation, and much more. There are literally hundreds of other ratios that can be used, but these will have to be covered perhaps on another occasion. I should just add that as far as possible, I've tried to use the same nomenclature as my colleagues have used in their presentations. Now I'm going to focus on the main financial ratios. Ratios can be expressed either as a number, a percentage, or as a duration, i.e. days or weeks, the fundamental being that one number is divided by another. Ratios provide a snapshot of the business at a particular time, but by generating a series of ratios over time, this will allow important trends in the business to be determined. The selection of those key to your business must be based on a thorough understanding of the business and its objectives. I'm going to start with liquidity, which assesses the basic financial soundness of the business and its ability to pay its debts fully and on time. And the first of these liquidity ratios is the current ratio that you can see on this slide. And the current ratio is defined by dividing the current assets by the current liabilities. This looks at the assets that are available to pay liabilities falling due within the financial year. Usually that's 1 year. You'll have seen from Paul's presentation that these are divided as current assets as shown below and together with the current liabilities. The higher the ratio, the better the company's liquidity position. It should be at least 1 as an absolute minimum. Anything below this indicates potential problems. I now move on to the next ratio, which is called either the quick or the acid test ratio. And this is defined by dividing the current assets minus the inventories and divided by the current liabilities. This is a more stringent test of liquidity that looks at those assets which can quickly be turned into cash. So inventories, raw material and work in progress that Paul discussed earlier, that usually cannot be sold immediately, are deducted. Now move to the solvency ratio. The solvency ratio provides an assessment of the company's financial viability. The cash flow of the business is calculated by adding back depreciation and other non-cash expenses to the net after-tax income. This cash flow is then compared to all liabilities rather than only short-term debt. The solvency ratio assesses a company's long-term health by evaluating its ability to repay both its long-term debt and the interest on that debt. As an approximate guide, a solvency ratio higher than 20% is considered to be financially sound. However, solvency ratios vary from industry to industry. I now want to move on to look at leverage ratios, which measure the amount of capital that comes from the shareholders or the owners of the business and the amount that comes from debt, i.e. from loans. The first of these is the debt ratio, which, as you can see, is taking the total liabilities and dividing by total assets. A debt ratio greater than 1 indicates that a company has more debts than assets, and conversely, a debt ratio less than 1 indicates that a company has more assets than debt. From a pure risk perspective, lower ratios, i.e. 0.5 or lower, are considered better debt ratios, since the interest on the debt must be paid regardless of business profitability, unlike dividends to shareholders. And excessive levels of debt obviously may endanger the entire operation if cash flow is significantly reduced. Companies unable to service their own debt may be forced to sell off assets or go into receivership. A higher debt ratio, 0.6 or higher, makes it difficult to borrow money. Lenders often have debt ratio limits and are not prepared to extend further credit to the business. The next ratio is the gearing ratio. This determines the total debt and financial liabilities compared to shareholders' equity. It can vary significantly from one sector to another and between different countries. Clearly, the higher the ratio, the more exposed the company is to an unexpected downturn in the business. A high gearing ratio shows a high proportion of debt to equity, whilst a low gearing ratio shows the opposite. Capital that comes from creditors is riskier than money that comes from company owners, since, as I've already mentioned, creditors still have to be paid back regardless of whether the business is generating income. Many family businesses that are successful are largely or entirely financed from their own funds. But remember that generally the cost of servicing debt is lower than the cost of equity, i.e. the cost of paying dividends. Hence, for instance, venture capital companies have very high gearing ratios. A gearing ratio higher than 50% is typically considered highly levered or geared. As a result, the company would be at greater financial risk because during times of lower profits and higher interest rates, the company would be susceptible to either default or even bankruptcy. A gearing ratio lower than 25% is typically considered low risk by investors and lenders. A gearing ratio between 25 and 50% is typically considered optimal or normal for well-established companies. We now move on to profitability ratios, which measures a company's ability to generate income relative to revenue, balance sheet assets, operating costs, and equity. And the first and perhaps the most important of these is the profit margin, with which many of you will be familiar. The profit margin is a ratio of the company's profit, i.e. sales minus all expenses, divided by its operating revenue. But remember that the profit margin can also be expressed as the gross profit compared to net sales to show how much profit a company makes on its products after paying for the cost of goods sold. A good margin will vary considerably by industry, but generally a 10% profit margin is considered average, a 20% margin is considered high, and a 5% margin would be low. Remember, however, that gross profit margins need to be substantially higher, say in the region of 30% plus, as the fixed cost of the business have to be deducted before determining the net profit margin. The next ratio is the return on shareholders' funds, which measures how efficiently a company is using its equity to generate profit. The return on shareholders' funds ratio shows how much money is returned to the owners as a percentage of the money that they've invested in the company. So as you can see, it's the net profit after tax times 100 over shareholders' funds, hence expressed as a percentage. Return on capital employed. This is one of the key ratios used by the financial sector investors, providers of capital. This ratio measures how efficiently the company is using its assets to generate profit. A higher ROCE shows a higher percentage of the company's value can ultimately be returned as profit to the shareholders. Companies create value when they are able to generate returns on capital above the weighted average cost of the capital that they use. Finally, I'll refer briefly to three more essential ratios that indicate both the efficiency of the operation and the control of its cash. And the first of these is the inventory turnover, which, as you can see, is expressed as the ratio calculated by dividing the cost of goods sold in a period by the average inventory in that period. A high inventory turnover generally means that goods are sold faster, and a lower turnover indicates weak sales and excessive inventories. Inventory turnover can be compared to historical turnover ratios, planned ratios, and industry averages to assess competitiveness and intra-industry performance. Inventory turns can vary significantly by industry. For most industries, a good inventory turnover is between 5 and 10. This ratio would then indicate that inventory is sold and restocked, say, every 1 to 2 months. But supermarkets, for instance, will have a stock turnover measured in terms of a few days. On the other hand, manufacturers of heavy plant and machinery may have legitimately a turnover of many months. The next slide is receivables, are often described as debtor days. As you can see, it's calculated by dividing debtors, or accounts receivable, by operating revenue and multiplied by 365. Debtor days are used to show the average number of days required for a company to receive payment from its customers. A high figure, more than the industry average, may suggest general problems with debt collection or indicate financial problems with major customers. The efficient and timely collection of customer debts is a vital part of cash flow management. The last of the ratios that I'm going to discuss today is payments or payables or creditor days. Creditor days, as you can see, are calculated by taking the trade creditors, accounts payable, and dividing by the operating revenue and multiplying by 365. Creditor days estimates the average time it takes a business to settle its debts with trade suppliers. A business that wants to maximize its cash flow will take as long as possible to pay its bills. However, there are obvious risks associated with taking more time than is permitted by the terms of trade with the supplier. One is the loss of supplier goodwill, and there is also the potential threat of legal action or even late payment charges. It's ethical to pay suppliers on time, particularly if the suppliers are much smaller and rely on timely payments of their invoices in order to manage their own cash flow. I trust that in the limited time available, you've been able to gain some initial insight into the importance of ratios and how they are calculated. I thank you for your interest. We now move on to the discussion stage, where you are welcome to put forward your questions, and I will hand over to Paul.
Thank you, Christopher and Tim. And for everybody who's listening to the event on the webinar, I've just noticed my screen has gone black. So that's hopefully that's not affecting everybody, but obviously it's going to give me a tough time with the question. So we got a couple of questions in that I noted that seem to link together. And the first one of them was about what was the difference between management and financial accounting. And then there was a question about goodwill. And I'll have to ask Emma Pateman from the Institute to feed me some questions, because I've lost the webinar again, which is rather annoying. So shall I address this first to Tim and then to Chris, and the difference between management and financial accounting?
Yes, thank you, Paul. I think in simple.
Hello?
Hello, this is Christopher. I'm looking at the first question here, which I think refers to where you can assess company information. The usual, and indeed the main source of information, is from Companies House, and they have a website, and it's possible to access information on the financial performance of every limited liability company registered in the UK. But it's hard work then to fully analyze the information that is available. And there are a number of companies who will in fact undertake the analysis for you. There are large organizations such as Bloomberg and other major companies. But the problem is that the costs of using those services are quite high. There's also another organization called the Bureau van Dijk, and they produce also detailed analyses of company performance under the names Amadeus and Fame. And they will not only analyze the raw data from the balance sheet and the profit and loss account, they will also produce a whole series of ratios, some of which I've been discussing with you today. Tim, would you like to add any further comment?
No, Christopher, I think you've covered that question very well. Thank you.
The only thing I'd like to add to that, Chris, is most companies, if they're either publicly held, whether it's UK, America, or anywhere else, their annual report information is available. So publicly held companies are easier to get at than privately held companies.
Paul, are you taking over leading on the questions now?
No, I'm still rebooting computers madly at the moment.
All right. Can you help me, Emma? I can see another question here. See only part of it. Can you supply a copy of, I presume that's a copy of the slides. If that's, Gareth, if that's what you're intending, yes, we'd be very happy to provide those. And if you make contact with Emma Pateman, she will certainly oblige in that respect. I think there is another question that came up, which I think is quite relevant, and that is, what is the difference between financial accounts and management accounts? Now, as you've seen from the presentations by Paul and Tim, the financial accounts follow a very strict structure, and that is determined by legislation, and that is designed to ensure that the public at large have access to the relevant information. Now, with management accounts, those are internal accounts, and they are, by definition, much more granular than are the financial accounts. In other words, they provide a lot more additional information, often confidential, the sort of information that you would not feel comfortable were it accessible by the competition. When you look at the structure of a management account, usually it compares the actual performance of the business against the budget. And also, in many cases, the management accounts are structured to compare the performance at a particular time during the financial year with the same performance in the previous year, so that this allows management effectively to control and monitor and regulate the performance of the business. Tim, would you like to expand further on that?
Well, Chris, I think you've given a very good explanation. From my perspective, financial accounting tends to look at the past and at best the current, whereas management accounting allows you to look more at the future, provides more information to help with forecasting and projecting future action.
Good. Now,
okay, Chris. I'm just recovering some IT here. I think the question I was reading before it went off was a question which was about goodwill on the balance sheet, which is an interesting area of goodwill and brand, what they are. Is that a question you could take, Christopher?
Sorry, Paul, I've just had a problem with my audio question. I'm not hearing you very well. Could you just pick that up? I'll come in as soon as I can.
Yeah, okay. So the question was asked about the what was meant by goodwill on the balance sheet. And the simplest explanation I can give of it, which then Christopher can expand upon, is that when you buy a company, you've got the tangible things that you can look at. You can look at the value of the property, the plant, the equipment it's using. You can look at the cash at bank. You can look at the value of the raw materials and the stocks. And you can, but it's hard to put value on things like that. Gives a very low value for the company, and the value that somebody will actually take for selling you the company is a lot higher. And that is the difference between the tangible things that you can value and the actual price you'll pay is largely the goodwill. And a large chunk of goodwill in there these days tends to be brand values. And it's an interesting principle of accounting that until a brand has been sold, you can't actually recognize its value on the balance sheet. So if you're a Nike of this world and you've never sold the brand Nike to anybody else, then you can't actually put a value on it. But of course, it's massively valuable. Anything to add, Christopher, on
yes.
goodwill?
Yes. Sorry about that, Paul. You've defined that very accurately. You made the point in your presentation that a balance sheet does not in itself value the company. In other words, what some other person or other organization will be prepared to pay for it. And you've identified things like marketing information, but one can also add things like intellectual property or the value of research and development, which again, very often is not directly valued in the balance sheet. So just in summary, goodwill is essentially the difference between the balance sheet value of the business and what somebody was prepared to pay for it. So if you have a large group that has purchased a smaller company, you can't just simply put the balance sheet of the acquired company and merge it with the balance sheet of the acquiring company. You have to include this element of goodwill, which is the difference, as I said, between the purchase value and the balance sheet value. That, in summary, is the position.
Thank you, Christopher, for expanding on that. I'm unfortunately still not seeing any of the questions that people are raising. So if you can help with that.
Yeah, and Paul, I can see a number here, and a couple are very much focused on advice people are looking for around getting more exposure, experience, and awareness of accounting matters. And Raphael talks about studying for CIMA. Is that a good option? And then David's also asking about short course for engineers. What would you recommend? So that would be a good one to answer, I think, Christopher and Paul. Who'd like to go first on that?
Christopher, would you like to go first, and then I'll add a bit from my personal experience? In terms of qualifications, let's pick up the SEMA thing first. Obviously, SEMA is focusing mostly on management accounting, and from what I see of working with people who have done SEMA qualifications, it's extremely good and rigorous training, as is the Chartered Accounting training, which is aimed at financial accounting. So I think, yes, they are both great. And they're reasonably expensive, but they're very thorough and they're internationally recognised. In terms of other routes, then parts of MBAs, some of them are very strong on finance and accounting. So parts of MBA courses. There are some exceptionally good books out there. I'm trying to remember what my personal favourite is, but it's there are things like Wall Street publications that are introducing to accounting, and then you've got a whole series of very good books done by an organisation, by a chap called Kaplan, who's a good guy to look out for. Personally, I think you can't know too much about accountancy and finance, and particularly getting in. We're talking at the moment about accountancy. When you start getting into how to finance companies, it starts getting really interesting stuff. So without me dragging on too much, I'll hand over to Chris and get his opinion.
Yeah, Paul, again, my apologies, but I lost part of the audio. I was fortunate enough to be able to go back to university and do an MBA. And for those of you who can manage it from in the context of the cost and the time that you have to take out, it is a very valuable thing for an engineer to be able to undertake, particularly one who has an ambition to move into more general management. So I would encourage that. There are also many good part-time courses leading up to an MBA, which are helpful too. But the one thing I would, on the basis of my experience, like to say is that it is much easier in general for an engineer to become knowledgeable about finance and accounting than it is for an accountant or a financially orientated person to become knowledgeable about engineering. By definition, as an engineer, you have a mathematical background, and that is, in my experience, very helpful when it comes to studying and understanding finance.
Mm-hmm.
And Tim here, maybe if I can just round off and possibly close out our question session by adding my perspectives. I achieved my current level of competence and confidence in accounting and finance matters through three sources. First one was doing commercial awareness type courses in my early years. There used to be a diploma in engineering management, but now I don't think that exists anymore. But general commercial awareness is a very good thing to look out for. I think the IMechE might offer some of that. Secondly, I did do an MBA some years ago, and that, although whilst I'm not a qualified accountant, that was a definite exposure to things accounting. And thirdly, probably most important, is actually this experience and being involved in working with accountants and learning from them. So that would be my, those would be the three things I would add to the pot, as it were. And then I'll hand back to Paul. Maybe I suspect from the time we'll probably be closing out soon.
Yes, I mean, I would concur. I've done an MBA as well, but I think one of the things that's very important is developing that business acumen, because as Chris pointed out, being an accountant won't make you a good business person, and it's a very hard route for somebody who's just trained in accountancy to understand what's going on in engineering. it's probably easier to go the other route. So I'd say there's some great reference material out there, and I would start there and just read up more on the basics and then decide which way you want to steer yourself. Could we have another question? I'm still without being able to see the questions list. So
there's another question that's come up, essentially saying, how do you decide on the good financial health of a company? And how I would respond to that is, yes, of course, you need to look at the balance sheet and the profit and loss account. But what in parallel with that, extremely important, is to see the trend over a number of years. When Paul was making comments about provisions and accruals, I think many of you will have realized that there is a degree of subjectivity in how accounts can be structured over, let's say, a period of 1 year. And it is possible to move profits or losses from 1 year to the next. But always, if you're involved in assessing the real strength or otherwise of a business, you have to look at its performance over a number of years and see what the trends are. Also, when I'm involved in this type of work, looking at the propensity of the business to invest, whether it's investing in people or whether it's investing in new products or plant and machinery. That, to my mind, is a very important indicator of the longer term strength of the business. Mm-hmm. Also, one of the key indicators that I use is take the total sales in any 1 year and ask the question, what proportion of those total sales have resulted from products that have been introduced, say, in the last 5 years? Because again, that will show the direction that the company is going in. Yeah. We live in a world, certainly with venture capitalists, whose basic strategy is to buy and sell probably within a time period of 5 years. They will do their very best, and I'm using this word carefully, to adjust the accounts to show the maximum short-term profit. But if you really want to be sure about the value of the business, look at the trends over a period of time.
I think that's a very important point, Christopher. I mean, we're going into a period of unprecedented change and instability, and part of my role is to evaluate business and business quality. And I'm looking at the way I'm doing it now to see if there are better ways where I can handle this uncertainty. But picking up on one of the themes that Christopher ran there is it's the vitality of a company. And some organisations actually publish a vitality index. And I think when I did my MBA, the average life of a market at its largest. So you had to the point at which you're developing a market for a new product, and the market growing, and then the market changing, maturing, and beginning to die. The beginning to die comes about 5 years after the point at which it's actually become a market. So that point that Chris was making of looking at how much of the revenue is coming from products developed within the last 5 years is really a very, very important question. Because I would hold that companies that aren't developing now are probably going to struggle to survive because of the unprecedented levels of change. Okay, how are we doing on the question front?
I think we've covered most of them, from what I could see, or variants of them. I'm just conscious of the time. It's now 5 minutes past 1 o'clock, and want to make sure our guests are not being held up too long from their next appointments.
So I think then with that then, Tim, we'll make the usual offer, which is the recordings, etc., are available via the IMechE. But also, I think all the presenters would be willing to answer questions if they were sent in via the IMechE. That would be good. So it just leaves me to thank everybody on the webinar for attending. Sorry we had some IT excitement again. I thought I was getting away with it, and then suddenly all the questions disappeared, which makes life a little bit difficult. So apologies again to those of you who had some sound problems I was seeing going on earlier. And thank you once again. And I do hope you're not put off coming to one of our webinars again. So thank you to Emma Pateman at the IMechE for organising this, and to my colleagues Tim Podesta and Christopher Simpson. Thank you once again, and look forward to hearing from you in the future. Goodbye.
Goodbye. I wish you well.
Goodbye.